Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week, we are going to take a look at Bristol-Myers Squibb, the giant pharmaceutical company, which has just made some big acquisitions. We'll figure out what we believe their true cash flow is, what we think that cash flow is going to look like in the future, and we'll look at the current stock price and figure out what kind of economic return we can make by owning the stock long term. Ready to do it? Let's get started. Okay, before we review Bristol-Myers Squibb, let's go through the 5 key attributes for all cash flow investments that we make. First, we need top-line revenue growth. Second, EBITDA growth or earnings growth. Third, we need strong free cash flow. We need low debt, less than 3 times EBITDA is our measure for debt. And we need a well-priced stock. We use enterprise value to EBITDA as our measure of pricing. We need that to be a well-priced. Doesn't have to be cheap, just not too expensive. All right, I've pulled these numbers from the annual 10Ks from Bristol-Myers Squibb. Let's take a look at revenue and earnings and see how they've been doing. So these numbers are in dollars millions for Bristol-Myers, and you're going to notice something pretty interesting. 2012, $17.6 billion of revenue. 2020, $42 billion of revenue. That is a monster jump, mainly from 2020 and 2019, where they made 2 large acquisitions. But over the whole, this entire revenue growth has grown on average 12% over this time. I'll also note that there was a new CEO installed in 2015, and you can see this area is pretty flat. That's probably what got the last CEO kicked out. New person comes in, and we start growing. So I really like what I'm seeing here with the tenor of this CEO. He is growing the business organically. He's also going and buying new drugs that have good market potential. And I think that is a great cadence for this business. Let's take a look at earnings. Our earnings that we use is EBITDA. Remember, it's higher up on the P&L, so it doesn't include some of the acquisition costs, some of the one-time items that can cloud what the steady state of a business ought to be. That's why we use EBITDA. And that stands for earnings before interest, tax, depreciation, and amortization. Here, $5.2 billion in 2012, up to $18 billion. That is a lot of jack. $18 billion last fiscal year as of December 31st. Good job, Bristol-Myers. That's fantastic. Again, this section kind of flat, probably got the last CEO tossed, and then from here, it's been growing. As they've acquired those businesses, as they've turned on their revenue model, they're getting to, turn on the earnings model, they've been beginning to grow that number nicely, which is great to see. That's culminated in about a 17% annualized long-term growth rate in EBITDA. I'll also point out that that growth rate is larger than revenue, which means margins are expanding as they grow. That's fantastic to see. So both those are going to check our box. Now let's take a look at enterprise value. To get enterprise value, we always start with the debt. Both short and long-term debt for the business has gone from $7 billion to $51 billion. Now, $51 billion is a lot. That's a big move here. That's about 8 times growth rate on the debt number. But can the business support it? Well, we're going to look at enterprise value. It's going to be EBITDA because EBITDA pays for the debt. You need the earnings to pay for the debt. This is about 1 times. Here, that's a bit bigger, maybe 3 times. We'll take a look in a second, but it does look like they can afford it. Back to the enterprise. We're going to start with this. We're going to remove or subtract the excess cash that they have. Now, they're profitable, so they have cash building up, and that cash belongs to the current owners. And if we're going to look at buying the entire business, right, as an analogy, we're not actually obviously buying the entire, we're buying the stock, but to do an enterprise level valuation, we need to remove the excess cash. Market cap, total shares outstanding, times average price. I use average price for December, which is their fiscal year, around the time these numbers are all pretty much embedded in the market. So we use that, we add this with that, less that we get enterprise value. $48 billion to $187 billion. Monster growth in the enterprise value, kind of on the back of both growing earnings from 5 to 18 and growing debt from 7 to 50. So kind of a mixed bag here. Let's take a look at our value metric and our debt ratio to see where we fall. We'll pick the debt first. Net debt to EBITDA. Net debt is debt less cash, or excess, divided by EBITDA. So that's the number of years of operating earnings that they need to pay off all debt, a key metric of our risk for bankruptcy. And you can see back in the day, they were 1 year's very low. They levered up to do some acquisitions. They got to 5 times, and it looks like they were starting to realize that EBITDA from buying those businesses, and now they're at 2.7 times, which is less than our 3 benchmark that we look for. So that's a great check. Remember, debt is the enemy of the equity holders. When times are tough and the earnings are down, you can get blown out of your position and you can lose everything if the company goes bankrupt, because all those people will be in front of you in the courthouse asking the judge for the money back. What you want is a company that has little to no debt. So if something should happen and you wind up in bankruptcy court, you're the only person standing there saying, hey, can I have my money back? That's what we want. And it's not too greedy to say, hey, I want growth and financial discipline. It can happen. So this seems like it's checking the box for me. Enterprise value to EBITDA, that's our value metric, right? That is a quick check on price. We can use this to compare it to other pharmaceutical companies to see what they're trading at, to see what the market flavor for this business is. And what you'll see is at times it gets very rosy. 23 times enterprise level to EBITDA, that's 23-year payback. That's a big multiple. As a low point, 9 times enterprise value is a very cheap multiple. And currently it's sitting at 10 times, which I was astonished by. That to me seems very cheap for a company that for almost a decade has traded higher than that. That seems like a very interesting entry point for me for a company growing revenue and EBITDA both at double digits on with debt that still checks our box. I really like that. Let's go to the cash flow statement, and we're going to check to make sure that the EBITDA is translating into cash flow. All right, so here we are with the cash flow statement. Let's take a look at the cash flow from operations, the first third of the cash flow statement. 2012, $7 billion of free cash flow operation. 2020, $14 billion. Annual average growth rate, 9%. You can see in this region, aside from the 7, but in this region, that's pretty flat, which dovetails with the flat EBITDA that we saw prior to the CEO's change. And since then, it's been growing in line with EBITDA, totaling 9%. That means that the earnings that the company is saying, hey, we made this earnings, that's translating into cash, which is what we want to see. There's a lot of garbage out there in the market right now where people are saying, hey, look at me, I grew earnings, but cash flow's going the other direction. Be careful, always do that smell check. I like that, that's great to see. CapEx, what is CapEx? Capital expense. It's the money that they have to put back in the business to keep the machine going. It also includes growth capital. So it's not acquisitions that they make, but it is expansion of a manufacturing facility. If they want to build a whole nother wing, put lab equipment to analyze a different drug, that is growth capital, growth CapEx, and it's in this number too. So it's both maintenance of like putting a new ERP system in for the accounting team, painting the building, new equipment, moving on to a cloud infrastructure. All that stuff is kind of maintenance, if you will. But then expansion is also in this number. And so what you're seeing here is about $500 million to $753 million last year that they put back into the business to keep the ball rolling. And that is very low relative to the cash, hard money that they generated from running their business. Kudos to those guys. I love seeing that. Payment of debt, what's going on here? This is the inflow and outflow of do they borrow or pay back the bank. Positive number is inflow, negative number is paying down debt. And what you're seeing is they're borrowing money, right? That's the spike that we saw in debt right there. And even last year, net debt, they took in money despite the 2.7 times debt multiple. They can still afford to borrow more. I'm going to consider that free cash flow to equity, and I'll pass it all the way through, and I'm going to get a fantastic number of $17 billion of free cash flow to equity. That is fantastic. This is the number the company's value should be based on. And what I'm seeing here is I'm going to run my little drug company. I'm going to make $14 billion a jack. I'm going to peel off $700 million, and I'm going to have almost $13.5 billion right here left sitting in the bank account. I'm going to go to the bank and say, hey, I crushed last year earnings. Can I borrow some more? They'll look at the financials and say, yeah, you can. You're less than 3 times. We'll give you more money. So they borrow that, and that's where I get $17 billion. Whew, that's a lot of jack. Good for them. If I take that and I say, okay, what's that on a per share basis? Well, open up the 10K, look down the income statement. You will see share count 2.2 billion shares. Divide that into the 17 billion, I get $7.62. That means for every share that I buy, I have a claim on that cash flow of $7.62. That's not that they're not going to dividend that to me, but that's my pro rata share of this entire nest egg that they just realized. Current share price, at least December last year, $61, about 64 now. So when I take the yield, when I take the cash flow from equity, divide by the price, I get a yield 12.5%. That's a very high yield, very strong number. You can see in history it has not been that high. When that market multiple was a little higher, the cash yield is a lot lower. I think that's really interesting. Maybe it's a product of the recent acquisitions that they're making. There's a lot of kind of clouded data in the P&L. When you read down it, there's a lot of charges in there related to the acquisition, but they're one time. They're not going to happen next year. They're a product of the acquisition. So we add those back because we are focused on what is next year's earnings going to be, and the year after that, and the year after that. So we want a stabilized run rate. And when I add them back and I look at EBITDA, I'm in that $17-18 billion range. That's a lot of money. So I get a strong yield, great to see. Now, what do we do? How do we forecast this business, and what do we think it's going to be worth a decade from now? For that, we are going to go to the most recent quarterly PDF that they released along with their quarterly earnings result. So here we go. Here's the quarterly Q4 earnings release from Bristol-Myers Squibb as of February 4th, 2021. This is the new CEO I said earlier, the chairman of the board and the CEO. He started in 15-ish. Good job, sir. You're doing a great job. Keep it up. Some high-level information. Please read it. I'm moving forward, trying to get this thing done. Here we go. Good slide. There are two things that a pharmaceutical company has. They've got their existing drug portfolio and they've got the new pipeline. The existing portfolio has exclusivity on a drug. It's a cash cow. It just generates tremendous cash, but exclusivity runs out. Competition floods the market with generics. Margins fall, growth rates fall. The new drugs that they're developing are there to offset the decline of the existing portfolio. That's the balance here. And what these guys are doing about developing their existing drugs and going out and buying drugs that fit in the 4 buckets they're trying to go after, that they believe they can monetize. And good for them. What this is saying is twofold. One, dark blue here, that's their existing portfolio. This is going to fall off soon. So they have a little piece that's going to fall off. If they go forward into time, this big section becomes a smaller piece of the pie as the growth model kicks into about 40% of total revenue. That's where that growth piece comes in. So overall, they're saying, hey, we're going to be growing low to mid single digit revenue CAGR. That's compound annual growth rate. If you see CAGR, CAGR, compound annual growth rate. Low to mid single digit as an entire business top line revenue. Also, they're saying, hey, maintain strong profitability, low to mid 40% profitability margins. That's fantastic. I love to see that. They break down the growth piece. They're expecting $20 to $25 billion of non-risk adjusted, NRA, non-risk adjusted revenue, potential 2029. I'm going to give them credit for 75% of this. I'll show you in a bit, out to 2029. The rest of it, their drug pipeline. The last slide that I really liked was this one. It shows kind of their portfolio of drugs, and it's a lot of green arrows year over year. I'm liking that. Kind of diverse, kind of actually high single digits on average. That's fantastic. Kind of diverse. So I like a lot of that, what we saw. Let's go put this into our forecast model and see what we get. Okay, behind me is the growth model I'm going to use for this business. And I'm going to take the existing business that they have now and grow it at 2% out in the future, that they'll be able to have their normal pipeline that they're going to have, expand pricing, maintain market share, and they're going to grow that at 2% over time. Then what's going to happen is the growth piece is going to kick in 2029. I said 22.5 billion. They had 20 to 25 billion of potential revenue. I'll split the difference, 22.5, and I'm going to feather it in over time that they'll build into that growth. What they gave us was a non-risk adjusted number, so I'm going to risk adjust it and say I want to cut it by 25%. So this is 25% off of this number. I sum the total, being the base plus the growth less the risk adjusted, and I get a number here for total revenue. And what I do is I smell check the growth rate, total revenue, mid-single digits, which is what they said. So I think mid-single digit revenue in line with their expectations. I then apply a 40% margin, right? They said low to mid 40s of operating profit. I'll just give it a hard 40. They're currently at 43, so I'm being a little conservative, and I get an EBITDA forecast out in the future. One caveat, next year I've increased it because in there, both in the the quarterly number and their annual 10K, if you read through, you will see synergies based on the acquisitions that they just made. They believe they can get $3 billion of synergies out of the combined business. I've given them credit for $1.5 billion, just taking 2020 EBITDA, grow it by $1.5 billion. That's it. No organic growth, no nothing else, and I get 19. I then come into my forecast model, and it does create a down year in EBITDA. I'm focused on the long term, bridging this gap, whatever. But we're going to really peg our value off this. I think this is close enough to what they're saying they intend to achieve. Okay, so now we're going to take that same EBITDA forecast and we're going to drop it into our model and come up with a long-term price target for Bristol-Myers Squibb. Here's the same EBITDA targets you just saw. Here's the EBITDA growth rate that I explained earlier with the revenue 40% margin, and I'm using a 17 times market multiple. Remember, it's currently trading at 10, which is abnormally low in my opinion for this business and based in history. I'm bringing it back to the average, which is 17. It's been as high as 23. So we're going to see a big market multiple expansion over time. That's going to drive share price growth. That's part of the trifecta that I talk about that we want to find. So I'm taking 17 times future EBITDA target. I get about $500 billion of enterprise value, less some debt. I'm using 2 times EBITDA here. No cash, I didn't subtract it. Market cap, $421 billion. Less outstanding shares gives me a price target of $186 in 2030. If we do the same thing for free cash flow, here, free cash flow $5.64. I'm taking last year's cash flow number less a bigger CapEx number. Last year was $700 million. I've upped that to $1.3 billion based on what's in the 10K. They say they're going to increase CapEx. So I've increased that by taking last year's free cash flow from operations less a higher CapEx, divide by shares, I get this number. And I just grow it at the same rate EBITDA was growing at down below. And I get a long-term price target of free cash flow to equity per share, $7.94. I apply an average yield. I'm in this region here for the average yield. So I'm saying it's going to come down. This is abnormal. This is normal. That normal averages to 4%. That gives me a $200 price target for Bristol-Myers Squibb. Now we have 2 price targets. Okay, now we have 2 price targets for Bristol-Myers Squibb. I've got $200 based on a free cash flow to equity. I've got $186 based on an EBITDA market multiple approach. I'm going to have the 2 because it is a guess. We'll see what it is. I got $193 long-term price target at a decade. If I pop that into our handy-dandy IRR calculator, I can pick up shares right now for $64 a share. I get a stream of cash flow, which is my pro rata share of their business. It's not a dividend, it's my pro rata share of their earnings. I combine that into a flow. I sell it at my average price of $193, and I get a whopping 21% IRR, or 4 times my money on the pharmaceutical drug company by holding it for a decade. And this seems cheap to me. It seems like a high return The pharmaceutical drug industry is kind of hit or miss. It's kind of like a venture capital money where they might spool up a drug and get denied by the FDA. So whenever you buy into a drug company, you want to make sure that IRR is above market. Market being the S&P 500 at 10%. This is double that. I think risk adjusted, that's appropriate. When I played with the revenue forecast a little bit, taking down the base revenue a little bit more, I got into maybe an 18% range number, but still very healthy double-digit number. I think it's a strong, strong number, and I expect good things for this company. If I put it into a distribution change, so if you look at this video 6 months from now, you're like, hey, I finally have the jack, what should I invest in? Well, if the stock is still in this $64 range, definitely go for it. As it increases, the IRR comes down, I'd be holding back. If for some reason it should fall, definitely be scooping up more. This is a solid good for me. It's my best rating. I like the stock. I like what management's doing. I like the track record of success. I like the large cash flow they're buying. Oh, by the way, one of the acquisitions they made, they paid $15 billion in cash for. So they are generating cash. They're moving the metrics. I like what they're doing. It's definitely a good buy to consider for your portfolio. All right, before we end this sector, I want to look at one thing, which is Yahoo Finance. A lot of you ask me what data, where do I get the data from? To be honest, I pay for a service that gets me the data. It's pretty solid. But all data has problems because all data is essentially an API connection to the SEC. And like any API connection, you have to check the data because it's just an analyst, not a finance person, or excuse me, it's a software engineer, not a finance person doing the linking. They might not know what they're linking up. And Yahoo Finance, which has good data, it is free. I used it for years when I was younger, is pretty solid. But there are errors here and you have to look for it. And I highly recommend that you always look at the 10K to make sure what you're looking at is accurate. And I'm going to show you an error right now. Bristol-Myers Squibb, Yahoo Finance, right now, I'm going to go to statistics. I will look at enterprise value 100 current, $180 billion. That's about what we saw in the sheet, $180 billion. EBITDA, if I scroll down here, their EBITDA, $18 billion. That's close to my 18, right? Okay. But if I look at their enterprise value to EBITDA number, 36 times. That's wrong. The number is 18. 180 billion of enterprise divided by 18 of EBITDA is 10. This math is saying 36. So anybody out there who is screening this stock through Yahoo or scraping their feed and saying, just give me this number. Oh, it's 36 times way up. They're totally wrong. And I think what's going on in the market is there's A, so much jack in the market that people are throwing money in the market, but B, so much of that money is passively invested. More than 50% of all managed money in America right now is indexed. And indexes are passive zombie money where they don't look at anything. They simply I got $1, I'm buying SPY, I'm going to take that dollar and sprinkle it around 500 stocks. No matter what their relative value is, you're getting a pro rata share of the 500 stocks. So no one's looking at this data. And I think this is completely wrong. And if you take the time, I know it's hard, life is hard, but if you take the time to read the 10K, take a week, look at one company a week. Over a year, that's 50 companies. I mean, how many companies are you going to own in a portfolio? Not that many. Take the time, read the detail, do some work, think about it, and you can pick up gems like we just discovered because people are looking at this Yahoo data and it's wrong. All right, guys, my name is Cameron Stewart, CFA. Thank you very much for watching the channel. Definitely check the comments down below. I got Bristol-Myers Squibb from a comment down there. You guys are value-hungry investors. I love it. Keep it going. Tell me what else you want to see. Thank you very much. Bye-bye.